Welcome back. Now, ongoing political uncertainty, high but slowing inflation, elevated borrowing costs, and sluggish demand locally and internationally are weighing on the manufacturing sector. The industry fell back into contractionary territory during the month of August, post an encouraging uptick in July. This according to the Absa PMI, which declined from 52.4 in July to 43.6 in August. Miyelani Maluleke, who is senior economist at Absa CIB, joins us now to unpack better. Miyelani, a pleasure. Good afternoon.
Good afternoon. It's good to chat.
All right, Miyelani, let's talk about this. We did have quite a strong and encouraging month of July, and we seem to have pulled back quite a bit. How do we make sense of it?
Yeah, I know it's very disappointing, to look at the headline PMI back in contraction territory, but I think it's a number that we need to look at in the context of the last few months, right? So what do we see in the last few months? You think back to May, June, activity is very weak. It's very depressed. We see that in the data, and a lot of the anecdotes that we're hearing all the time is that some businesses may be holding back on some orders and may be holding back on certain things because of election-related uncertainty, right? But by the time we get to July, there's a huge bounce, right? We see a strong increase in activity. New sales orders pick up quite significantly, and what we're hearing is that it's all that activity that was held back in May and June. So you get that strong bounce in July. And I think that one coming into August, what you then have is that the base that you have for July is just very strong. That the nature of that improvement was not going to be sustained. And given the fact that the PMI measures month-to-month variation in activity, those kinds of levels that you saw in July was simply not going to be sustained going into August. So I think some of that pullback that we're seeing here is explained by some degree of normalization. But I think the thing that we should be clear about is here and all the time is that this PMI does not necessarily mean that the levels of activity were the same as they were in May. In June, we believe that activity in general is likely to have been stronger than what we saw a little bit earlier in the year.
Well, that said, Miyelani, I'm keen to also speak about issues of demand here, and not only in South Africa, but globally, and how that's faring. And I ask that also within the context of the fact that globally the environment is very uncertain. The Chinese PMI came out today. It's also not quite where we'd like it to be, and it does show that there could just be a global influence to what we're seeing here at home as well.
There's very little doubt about that because, I think one of the discussions that we've been having the last few months is to say, we've had this period more than 150 days, maybe not getting to almost 160 days with no load shedding. Why are we not seeing the benefit of that in the hard activity data? So why are we not seeing that in those parts of the economy that we know are very sensitive to infrastructure? And I think part of the answer to that, comes to this issue that you're talking about here, that infrastructure is necessary, but it's not always sufficient for strong economic activity. One of the things that you actually also really need to see is that businesses need to be seeing demand for products. And recently, we have seen that little bit of softening in some markets outside of SA, but even domestically, we know that demand conditions, we see this in the various indicators of consumer demand strength in particular, that domestically demand has also been soft. So the degree to which we then see that improvement in activity in the stable electricity supply environment becomes constrained, I think, by just the weakness of demand that we've seen.
Also keen to touch on you with what we're seeing with employment here. That also trading a little bit lower in the manufacturing sector. Now, we know that in South Africa, we just actually have a structural and chronic unemployment issue here. It looked like for a long time we were trading in the mid-40s here for the PMI, but now really lower 40s. That's a red flag for the economy at this time as well?
I think a huge red flag. It's 1 month set of data. Not unusual to see some volatility, but I think something that we have to keep a very close eye on. We're hoping that we're not going to be in these depressed levels for too long, because one, yes, as we said, infrastructure is starting to look a little bit better. Things are stabilizing, but we're also confident that domestically, at least, we should start to see some improvement in demand strength, and we're hoping that we should start to see relatively stronger levels of activity, which hopefully should support a bit of an improvement in employment. But certainly, I think when you look at this latest print for employment in the context of an economy that has such an elevated unemployment rate, it certainly is quite worrying.
Then let's also touch here on the conditions for the next 6 months and where we're faring the Miyelani. In my mind, if I think of the two-pot system, for instance, about to kick off and now already actually in motion, the possibility of interest rate cuts this year, it does speak of liquidity for consumers. It may be a confidence booster. Is that reflecting in this data this month?
Yeah, look, I think so. Yes, we did see a little bit of a decline in that expectation sub index. But I think if you look at the overall level of it, no, Tande, it's really still quite strong, well above 60. Tells you that manufacturers are looking at 6 months ahead. They see they see some reasons to believe that the environment will be better. We share that assessment, and I think to your point, when you look at the demand side of the economy, the consumer side of the economy, it's true there's been a lot of pressure as I've just mentioned, but we are in a space now where inflation has come down. We believe will continue to come down, which means that the income erosion that has come through from cost of living pressures, I think, should moderate quite significantly. We should start to get into a space where we see some positive real wage growth as well, which I think will be helpful. Secondly, interest rates, we believe they're going to start to come down. Our expectation is that September is actually the month where the South African Reserve Bank will start to slowly reduce interest rates. By the middle of next year, we think interest rates should be about 100 basis points lower than where we are right now. That's going to be very helpful. And then, of course, over the very near term, you got two parts. I know there's various estimates around this. Our view as Absa is that you should see roughly 44 billion rands between now and the start of September and the end of the year in terms of this of early withdrawals related to the shift to two parts, and I think over this coming months that should also be a bit of a boost to demand as well.
Well, Miyelani, a pleasure having you with us this afternoon, taking us through this date and also just bringing clarity to it all. That was Miyelani Maluleke, Senior Economist at Absa CIB.